Everybody still hear me okay?
Yeah, I'm sorry. We just got it recorded, and I wanted to just comment that at the bottom left-hand side of your computer is a place for you to be able to write in any questions, and we'll handle those questions at the end of Bob's time. And Bob's going to have about 40 minutes.
Excellent. Okay, so the idea here is we're not going to just work with something that doesn't have any foundation. We're working with tax lawyers that actually create this structure. We've been in front of a lot of different tax law firms across the country, and we've had no issues with that, and we've had not one issue in 10 years with the IRS. So that's been very good. An additional part, that I want to tell you is that we're currently actually getting a revenue ruling right now with the IRS. We're actually asking the IRS to rule on 5 different applications because, we always get the question from each client, is this legal? How can you prove it? Now, we show people how legal it is, and we show people what we're doing, and we show their tax attorneys, and we show them the code, we show them the history, and we show them the mechanics of it. But in addition, we actually are now going to ask the U.S. Treasury for a revenue ruling in writing to be able to show everybody. And this is better than a private letter ruling because in reality, this is for everybody's use with a revenue ruling. So for CPAs that are on the line or clients that understand tax law, they'll understand what a revenue ruling is. And that we're expecting to get some sort of feedback from the IRS in the revenue ruling side within 30 days. We predict that we would be able to have our revenue before year end in final terms from the U.S. Treasury in written format. So let's go to the next slide and we'll start out. The company that I started is the estate planning team. I'm a financial advisor. I work for a broker-dealer. I also manage money for clients. So I also thought that in our business and to differentiate ourselves from different advisors out there that we would start a company called the Estate Planning Team because our goals are really to lead with estate planning and to help people save money and diversify and show people different ways to save money than telling people how much money we can make them. I always felt money saved is money earned, and it's better to approach people with stuff that we know we can predict and versus stuff that nobody can predict. But yet I work with the biggest companies in the world to handle financial management, the Franklin Templetons of the world, and people that you already know up in the north part of the Bay, San Francisco. So my goal is to give you an understanding of the structure and also just an understanding of who the estate planning team is. We're a membership organization. We have a substantial amount of CPAs, attorneys, business brokers, title reps, financial advisors, insurance people that all work with us under our organization because their main goal is to help their clients to understand that there's more than one way to sell an asset. And that again, that's our goal. You can go to the next slide. Why we're so adamant about this right now and why I've really started this company and I felt that this was a good direction for CPAs and planners and business brokers as well as clients to look at is because you're one of those. The $17 trillion of wealth the baby boomers they're going to pass, there's over 77 million baby boomers currently, somewhere in that neighborhood according to the American Bankers Association. And really, they're not going to want to own a business and run a business forever. They're going to want to eventually retire. They either have children to pass it to or they don't have children to pass it to. They'd rather just retire, and their children has not taken an interest in the business. They've gone off to college and done something else, and they have no interest in running their business. So at some point in time, you as a business owner are going to want to sell, and you don't have the luxury of exchanging a business into another piece of property or into some sort of another business. You have really the capital gains, the depreciation recapture. Some of you have C Corps, double taxation. Some of you have S Corps, LLCs. I mean, the idea here is how can we how can we defer the double taxation on a C Corp? We can do it. How can we defer capital gains on the sale of your business asset? We can do it. And give you more money that you can actually work with at the end of at the end of the close that you're actually being able to get out of the business and deferring it. Again, the $17 trillion of baby boomers are looking for a way to diversify, get out, and have the ability to keep the IRS money working for them, and that's the big equation here. So let's go to the next slide. So again, property owners, business owners are reluctant to sell because of capital gains. Again, we're looking at 15% for the feds, 9.3 for the state. You got your depreciation recapture, depending on what state you're in. If you're in California, that's where you're at, and it could, certainly the states need money, and they're going to raise taxes. The federal government, we assume, is going to raise taxes as well. So again, let's go to the next slide. Our goals are really, in your situation, when you do want to sell, we don't want it to be you don't sell, because obviously it's the right time to sell and you think it's the right time that you can get the right price, but you don't sell because of the capital gains tax liability, the depreciation, unless you get your number or unless you really have to, but nobody really wants to pay that tax bill. Next slide. What we normally get with real estate that's related to a business is a 1031 exchange option, but again, not everybody wants to do a 1031 exchange. Certainly with a business, you can't do a 1031 exchange, so the next option really becomes our option. Let's go to the next slide, is the deferred sales trust. Now, for CPAs on the line or attorneys or anybody, it's just a made-up name. It's a trademark name. What it is, it's an installment contract, so everybody understands installment contracts have been in the code since the 1930s, IRC 453. But this is not a traditional installment, so everybody understands a traditional installment is if I want to buy your business and you're going to finance me, you don't pay tax on the money because I haven't given you the money. You're financing me, but you don't take constructive receipt of the cash because you're financing me, and then when you do receive your principal, then you're going to pay your capital gains. Meanwhile, while you're financing me, I'm going to pay you interest. I may pay you interest only. I may pay you principal and interest. If you get principal, you pay your taxes according to your basis and your schedule pro rata. If you take just interest only, you pay interest income. Well, in this case, we can structure a deferred sales trust around what type of payments you really want to able to achieve. What is it your goal? Do you want to take some capital, pay tax on it? Do you want to take interest? We can do that. Now, what you're getting is an installment sale, but when any installment sale, you always have to worry about the risk of default. The concern is what am I getting as collateral? Well, the traditional installment sale is you're getting your business as collateral. And what you don't want to do is sell it to me, and you don't know me. You've never met me. So, one of the concerns that you have with me is how do I know that this guy that's going to come in and I'm going to finance this guy is going to take over my business and that's going to sell it. I'm going to sell it to him for $5 million, and when I get it back because I have to collect on it, it's going to be worth $3 million. I've lost $2 million of value. That's the default risk that you have. And the other risk that I would say that would be another big risk to you is the issue of early payoff risk. You have to look at the other option of being paid off early, because I can go out and get cheaper funding from somebody else that can finance me on the sale of your installment contract to me, and I'll go out and borrow it from somebody else and pay you off early. So you got early payoff risk, and default risk is a very viable option. So usually when you get to a traditional installment, let's go to the next option, next slide, you usually just sell and pay the tax. That's what typically happens. And a lot of CPAs just pay the tax. You're in a low capital gains and rate environment, just sell and pay the tax. Well, I'm a believer in paying tax. There's nothing wrong with that as long as it makes sense to you, but a lot of people can't stomach paying that kind of tax. I mean, so they end up going back to option one, not selling, and that really doesn't do them any good because they ultimately come to that age as a baby boomer, getting older, want to be able to retire and smell the roses and live the life that they've always dreamed about. So let's go to the next option, the next slide. So let's just take, John, the sample case here. It's a little big and bold here on my computer, but so, in this case, you're selling your business for $5 million. You got a basis of $1 million. You got a $4 million case, capital gains tax, so 15% federal, and we'll just keep it at close to 10, so we'll make it 10. You're looking at 25% on $4 million. You're looking at $1 million of capital gains. So I don't know anybody on this phone that's going to really be excited about writing a check for $1 million to this franchise tax board in the state in the U.S. government. I mean, it's a huge capital gains tax liability. So let's see if we can show you how we can defer it and make everybody comfortable with what we're doing that can give you some good guidance on a good way to retire. Or even, you don't even have to be looking to retire. It can be just a good way to diversify your money out of, all business or all real estate or whatever holding that you might want to sell out that can give you a better chance of giving more diversification. So let's go to the next slide. So how the DST works is really simple. It's not too difficult. If you understand installment sales, it's just one more element of an installment sale that needs to happen here that, again, John and Joan have done, and they can tell you what they feel about this because they've done it and they like it. And again, we've done many, many, many deals around the country with people that really feel good about it and understand that there is a different way of selling and getting out. So let's go to the next slide. Okay, so this is, you have to, unfortunately I'm not able to kind of draw on this, so let's just take the clients up on the upper left right under where it says deferred. That's you and your spouse there. And what's going to happen here is below the spouse is there, you're going to see where it says assets to sales. So that's your asset. Now, when you do a traditional installment contract, you're going to need to sell to somebody that wants to buy it. In this case, we're using a third-party unrelated trustee service. They're going to buy the asset from you. And this is what the deferred sales trust is. It consists of a third-party trustee buying the asset from you under a traditional installment contract. So the trustee is going to buy it from you, in this case for $5 million. Remember, your basis is $1 million. You've got a $4 million gain. Now, the trustee is going to enter an installment contract with you and give you a rate of return on your money. That's all pre-negotiated. And the collateral is all pre-negotiated. At first, it's going to be your business until the trustee buys it. He's going to buy the asset from you, the business that you're selling, for $5 million. He's going to give you a note payable with either interest only or interest in principal with a rate of interest in a rate of payment that's achievable by him and acceptable by you as the bank would call you the creditor. Because what you're going to go from is being an owner of the business to now being a creditor. Now, you sell the asset to the trustee for $5 million. The trustee buys the asset for $5 million, and his new basis becomes $5 million. So he just bought it for $5 million. So he has your business. He owns, and what he does with that business is turns around and sells it the same day he bought it from you. He sells it with a new basis of $5 million to a cash buyer. So he bought it for $5 million, he sold it for $5 million, and now instead of you having your business as collateral, which is risky of him not being able to manage it, you sell it to the trustee for $5 million, and he turns around same second, same day, and sells it to the cash buyer for $5 million. He bought it for $5 million, sold it for $5 million, and now you've swapped collateral from being a business creditor to being the creditor of a business that you just sold to being a creditor of cash, which could be, as riskless as possible. Now, so you've just swapped your business to cash of $5 million as collateral. Now, to understand how to get your rate of return, the trustee is going to look at the investment of that cash needs to be invested in safe things. It needs to be invested in things that are going to be able to return your capital back to you at the end of the term, and it's going to need to be able to achieve the rate of return on the money that he and you have pre-negotiated. And in addition, you're going to have collateral on that asset of which whatever he buys inside that trust with companies such as Franklin Templeton, PIMCO, big insurance, there's investments in annuities. But so you just understand how secure you are is before the investments are even made, before you even transact, in this case, Joan and John were able to, because they're the lenders here, before they even sold their business,
It was a property.
their property, excuse me, be able to sell their property, is to be able to predetermine the risk of the collateral that they would accept as a lender. So before anything started, the trustee had some, understanding of what they would accept. So, the investment advisor, in this case me, worked with a trustee to prepare an asset allocation for their acceptance and approval and their security on that asset. Meaning, instead of having a piece of property that is collateralized, they have now a fund that that they have invested in that has almost $70 billion of assets. So they've gone from a piece of real estate to a $70 billion investment asset that is invested with a market cap that pays very nice dividends and also has performed very well in very volatile markets. And they've been ahead of the game from day one, and they've done very, very well, and they felt very secure that their money is very safe and managed by one of the top management companies. Well, this year and a few other years, they were the #1 manager in the whole entire world for asset management, Franklin Templeton. So
yeah, we've been pleased.
Yeah. So the idea is you get what you want because you're in the driver's seat. The advantage here to you is to be able to select the investment that you would approve, that the investment advisor and the trustee would be able to work with, to be able to negotiate the rate of return in the interest payment and the interest or principal payment that you would be able to live with, and negotiate the time and distance, the time horizon of what your outlook would be. And then obviously in this case you'd have an extra $1 million working for you because the trustee sold the asset for the same price that he bought the asset, and he's doing an installment contract back to, in this case, you and your spouse. So the idea is really being able to provide you more money at the time of close. And what the real question is how much money do you have to pay in taxes becomes whether this is worth doing. You have to predetermine, look, if I'm only paying $30,000 in taxes, I might as well pay my taxes. But if you're in this case where you're, paying $100 or $200 or, $1 million or even higher, then this becomes a real business proposal for you, because obviously, what are your real options here? You can do a traditional installment sale with somebody that could default on you or early payoff, or you can go with a third-party trustee with a collateral assignment agreement, because everybody asks the question, how am I so secure? How do I know that this trustee will not run off with my money? Well, first thing is you do your due diligence on the trustee. They're a 60-year-old CPA firm. They're a great firm. In this case, what they're doing is really they're in the trustee business, and that's what they do. And they also will work with you. This is their business. This is one of their business models. They like this. They see the diversification. On top of it, first of all, they're very reputable. Second of all, they don't even have the ability to be able to take money, because when the attorneys create this, they created a collateral assignment agreement, just like any lender, any bank that's going to loan you money that's going to want to have collateral. They don't just give you personal money and say, hey, go do whatever you want with it, and hopefully we'll get paid back. In this case, before the money's even negotiated, the money, the lien is on the business, and then it switches right to the cash. So you have a lien on the account, so that wherever the money's being held at Franklin Templeton or PIMCO or the insurance companies, MetLife, Axel Equitable, any one of those companies, they're going to have a lien on the account that has your name on it and says that the trustee owes you $5 million, and the money that goes in there is going to have a lien on it, so that without your signature, the trustee can't pull any money out, and it can't go anywhere except to you until the loan is paid off, including the interest. So that is the goal here, is to make each and every one of you understand that not only are you going to be able to diversify your money, but you're going to have more money to diversify, and you're not taking what's happened in the past won't be the future, because the goal is to put your money in all different types of asset allocations. And if you understand management of money, it's very important to have your money in different asset allocations, because one may go down, the other one may go up. But if you have a concentration in a business and your business sector happens to be the worst one, it was great when you sold it, but it turned out the guy that got in, something happened terribly in the industry and crashed it. It may not even be within or her control. It may just be an industry crash, like real estate and things like that, that it's uncontrollable and it's just going to happen. So what you want is when you do decide to retire or when you do decide to sell your business, that you ultimately can have the diversification at retirement so that you don't have to go back to work like a lot of American people. Let's move to the next slide. So again, these are kind of your options here when you're dealing with real estate, but from a business approach, you really don't have the options in the 1031 arena unless there's real estate attached to it. Now, let's keep going to the next slide. And I think that may be where we kind of end here. But I want to go into the C Corp because I know some of you may have C Corps. I don't know, but the C Corp is a little tricky. There's double taxation, so if you're going to keep the C Corp, obviously one thing, if they just, want the asset out of the C Corp, you keep the C Corp and we do an installment contract. In this case, the actual C Corp sells the asset to the trust. The trust gives back a C Corp note to the C Corp, and then the asset's sold and the C Corp is going to generate revenue. What's great about that is, sure, we're going to have the double taxation down the road, but we're actually keeping that taxation at bay. You can pay one tax. If you actually sold the corp, you could just pay the corp tax and then defer it at the shareholder level. We could do it that way. Or if you didn't sell the corp and you wanted to keep it, you could keep the C Corp generating interest income, and then what I love to do is pay the tax that you're going to get a lower rate, and I don't know how much, what you're generating as far as income at the corporate level, but to some degree you get a nice for the first what is it, $100,000 or below, you're going to get a better rate than you are at the next $100,000. I'm not a CPA to tell you the exact numbers, but I can tell you that you do get some benefits being in the first percentage of monies, on the lower amount that you receive is better. But then the next, you could actually fund it into a pension plan, defined benefit plan, and start doing some things with defined benefits that can, give you even some more offsets and do some neat things in the pension world. So, C Corps can be tricky, but yet we have a nice solution that can offset a lot of the interest income that you would generate, and then obviously helping the shareholders benefit, and if they're obviously the owners of the stock, and there's not a lot of owners, but the ones that want to take advantage of getting some pension deductions too. So we've dealt with that in a lot of situations, but again, C Corps are not a fun issue to deal with. But again, this is a very good strategy for people to have good diversification. We look at it as the future because again, nothing's guaranteed in life except death and taxes, and our goal is when you have market corrections like we had in real estate in certain areas. Again, if you have a recession, businesses can go up and go down, and the idea is to right now, if business sales are down, or you're not getting as much for your business as you once thought, then that extra $1 million is going to be meaningful to your retirement, or very meaningful to you keeping that money on your column than giving it out to the state or to the feds. The other point that I wanted to make is, if you're going to continue to make investments in businesses and things, you can expect to lose money. We all do. Nobody's perfect. And what I always like to say is that if you paid your capital gains tax now, then you basically went out and bought some other deal and you lost on it, then you're going to have a loss carry forward until you can offset it against a gain. The other point that I have in this situation is, let's say you haven't recognized the gain because you're still in an installment sale, but you're in cash instruments that could be traded at trade plus 3 between you and the trustee and you agree that they will actually liquidate the asset to offset whatever you lost in your next bad venture. Let's say you lost $1 million, and you came back to the trustee saying, geez, I lost $1 million, I could sure use that loss carry forward against my gain. I don't want to carry it forward for the years to come. I'd rather you offset it right now. Could we do that? The trustee could say yes. So let's amend the trust, and I'll send you out $1 million. You offset it against your $1 million tax loss, and away you go with another $1 million in your pocket without having to pay the government. So, the other questions that we get from people are, what's the cost of this? And then the other thing is, can this go on and on and on? Well, let's talk about the other. The first, it can go on. Meaning you can do a 10-year period. We typically go as far as 10 years. We can go anything between 3 and 10. After 10 years, what can happen now is the tax attorney, you, and the attorney that represents you would be able to negotiate another 10 years and an interest rate and a payment plan. If you're still around, great. If you're not, your spouse could do it. If you're both gone, then whoever is in charge of your living trust, or if this is a C corp, your corporate, your board can make a decision in regards to the note. So again, you can continue to keep the deferral going until you either find a time that you want to take it down and pay it, or pay it in several years where you could have some planning along the way. I think where a lot of people find it difficult is it's all coming now and you've got to pay the tax. It's always better if you can stretch it. Even though taxes could go higher, that's always another point that a lot of people say is, well, we're in a real low capital gains rate environment right now. And I always say to that, well, okay, but you have to look at the benefits of what we're bringing to the table. How long does it take to double money? If you could double money in 10 or 12 years, I mean, the money that you would have normally paid the IRS, right now, let's say it's 25 and you got your depreciation recapture, I mean, that's a substantial amount of money regardless. If we can defer that and keep that money working for you, that's a wonderful thing, and in 10 years it's doubled itself. And if you decide you want to do it again, you can do it again. So, that's a hypothetical if you can double it, but again, there's good ways to invest the money, and John and Joan can tell you how good we are and how good we work with their asset that they have that they have credit to, and how well it's been performing for them. So again, we can show the history, we can give everybody what they want and feel, as far as whatever the safety that they want, as far as the investment of the collateral that they're going to get, so that they know that they're diversified. But again, that's our main point, is to be able to offer you that. Back to the original cost of it, the cost is anything under $1 million. It's a one-time fee of 1.5%. Anything from $1 million and below, it's 1.5% of the actual sale, and anything over $1 million, it's 1.25%, and then it goes to 1% when you get to $5 million. Now, that's all deductible against it comes out like a real estate transaction. The good part is you don't have to pay that fee up front. It comes out of escrow, so it's expensed, number one. Number two, you don't have to pay any retainer fee. If the deal doesn't go through, there's no obligation to you whatsoever in regards to the legal fee. The other thing that comes with audit warranty, meaning that if you were ever in any situation where you were ever audited, the tax attorney that structures the deal provides audit defense, meaning he would handle the audit at his expense, no charge to you, and handle everything, and obviously protect your interest in making sure that the IRS understood it was legal. Now, going back to what we're doing on the other side of how we can make this happen in your best interest is, because we're getting the revenue ruling, there can be another additional warranty that can be added, and we believe truly that we'll be able to get that warranty added to your engagement agreement if you decide that you want to do this, is that we can actually refund all of your money with the understanding that we will, certainly you'll know it works, but just to give you the 100% guarantee from the attorney and the U.S. Treasury is that they'll put that in writing, that they will be able to provide you a revenue ruling before the end of the year to ensure you that it's legal and that you have the blessing of the U.S. Treasury. As well as, if they didn't, they would offer you the choice of going forward and continuing on without it, which we don't believe is going to happen, but if it did, you'd have that choice, or full refund and pay your taxes before year end. So again, our goal would be able to help everybody just understand that it is legal. We've been doing it for 10 years, and we have not had one incident with the IRS at all, with the exception we were audited completely. I was personally audited back in 2008. They learned about the structure on the Internet on our website that we have, and then they asked us to come in and basically tell them all about it in California, which escalated up to D.C., and then D.C. basically read everything and went through the notes and went through everything we were doing and closed the case out, and it was no issue whatsoever. It was completely legitimized. So again, they just installment sales have been around since the 1930s. This is just a different way of collateralizing your installment against different types of investments that are diversified versus just taking one asset class, your business primarily, and then having to worry about default risk and having early payoff risk. You get to choose the collateral, you get to choose the company, you get to look at the history of that company, you get to look at the ratings on the company, the guarantees that are associated with the companies that would pledge that to your money in retirement before that investment gets executed. So again,
Bob?
Yes.
We have a question, and it was a good one. Is my money tied up for 5 or 10 years, or can I take some out at closing?
Very good question. The answer is you can take money out at closing. Whatever you decide, because again, it's you and the trustee negotiating with your attorney and the trustee's attorney, negotiating what you want. So again, it's your money. You get to call the shots. Again, you obviously can take money at close and pay taxes now. So if you want to take money now, great. If you don't, you want to take it later. You can also build into the ability to have each year the ability to actually decide, on a certain percentage of your money that you can elect to either have or forego. So you can have that built in the contract that at your option of getting 10% out in addition to whatever you're taking. So you have some ability, or whatever you really want to be able to do. Again, it's contract law, and you guys can be very creative in creating the agreements between both parties.
Okay, we have one other question. John, you want to read that?
Yeah. At the corporate level, what about the personal holding company issue?
At the corporate level, that's not an issue. I mean, if we're talking about a C Corp, I mean, again, that gets a little bit, the C Corp is a little bit more of a complicated area, and again, that would be more of the tax attorney answering that, because I'm not the expert on it, but I can tell you that we've had that question posed in regards to the corporate, and it's not an issue for us.
Okay, and we can.
And whoever has that question, please note it, because I can actually get you on with our tax counsel, Todd Campbell, and certainly have you drill down on that, because that's a real good question, and I've seen it asked many times in regards to it, and I think there's a better answer than what I'm giving you.
Yeah, we will get our client that your attorney's name. Attorney's name, or is it the CPA? Okay.
Yeah, we'll pass that on.
There
was another question about the cost, but you already covered that.
Yeah, I think maybe the ongoing costs and stuff. There's there's the cost of the creation of the trust. There is the actual trustee charge. I didn't go into that. The trustee is going to charge 38 basis points to be able to be the trustee and facilitate the trustee services. That's annually on the assets of the money. But again, what our goal is to be able to negotiate with the tax attorney and the trustee a rate of return that actually is doable based on today's economic times. And we've done, if you don't mind me saying what kind of rate of return we've been able to obtain for you, Joan and John, do you mind me telling you?
Oh, it's fine.
We've been able to obtain an 8% rate of return, and the securities over and above the 8%. It's doing very well, and we've been doing very nicely for them. And again, they've been seeing I don't think there's been one time that their account has ever been below what they've put in. So we've done a great job of that. So again, And that's net of all fees. So just so you know, that's net of all fees.
We have one other question. Does DST pay tax on any income not distributed?
Very good question. The answer is, the answer is yes, depending on how we invest. So if we invest in non-taxable things, the answer would be no. If we're dealing with capital gains issues and things, the answer would be yes. We would have the trust would have to pay tax unless we invested in like things such as an annuity. We could defer the tax not only to the note payer, but we could defer the tax, and just let it continue to accrue under a deferral, and we can do that.
Okay. Okay. I think, John, was there anything else?
Yeah, I think it would be interesting to know how long does it take to get this plan set up, and when should it be set up?
Well,
on the sale of a business.
Well, very good question, and that's a very good point to bring up to everybody, because when you're dealing with business assets, there's a lot of different ways to set up the sale, the contracting. I know you guys are really good at that, but also from a tax point of view, it's really good to get the tax attorney involved at the very beginning stages of the negotiation when you're dealing with the seller. You are the seller. There's a buyer. And what you're really doing is bringing in the trustee as kind of the conduit between you two, because that's what they're in the business of doing, is buying that asset from you and then doing an installment sale with you and then selling it to the cash buyer that Joan and John have brought to you. I mean, the idea, though, is you guys are going to pre-negotiate all your stuff between the cash buyer, but instead of the cash buyer buying it from you directly, they're going to buy it from the trustee. So what's really important is we get in there sooner than later, because what we don't like to do is find out that you've negotiated a contract with with the cash buyer, and it's not not tax efficient. So it's not tax efficient. And,
are you talking about the allocation maybe that's been done?
Yes, the allocation and how it's breaking out, we could have changed that a little bit differently to actually benefit your tax situation. So it's really good that our tax attorney can actually give you some really good tips and helping you negotiate that. And again, we work right hand in hand with Joan and John on that. We've and in several cases, in this one case, we've corrected some of the situations where they were being advised in situations where they were not getting exactly the best advice from their own CPA. So we want to make sure that it's always good to get two opinions when you're going to go in for heart surgery. So in this case, we want to make sure that we have not only a CPA, which is very good, but yet having a tax attorney that's has got a master's in taxation, has been doing it many years, and worked for Arthur Andersen for many years. Very, very, very good tax attorney, and has done a lot of stuff with the IRS. That can give you a lot of insight to all of this. So it's just the more the protection that you can get, the better, especially when you're dealing with tax law, and the better we can try to frame it. So back to the original point, let's try to get them in there at least, as soon as you start kind of negotiating, if you can. If you can, and you're already down to the final, then we need at least a couple weeks to try to get this done to do it exactly right. There's a lot of moving parts, and when I say that is you are the bank, so we have to kind of show you what kind of recommendations the trustee and the advisor would have to show you how the investments would operate to be able to achieve the rate of return that you want to negotiate. Now, before we even actually do the transaction, we want to do a risk tolerance questionnaire on you, so we can just kind of find out as much as we can about you as an individual or as a couple, and be able to kind of measure your risks, so we know specifically what those risks are, and tell you what we've discovered, so that we can make sure that we're all on the same page. Once we do, we share that with the trustee. The trustee knows what kind of investments should be offered as collateral, and then from there, then the proposals for the investment options would be submitted to you as the bank, being the creditor, to be able to look at and review. And if you like them, then it's really boils down to accepting them, and then understanding how the DST works in writing and the mechanics of it, and then closing it. So again, the longer that we can go through, the better you become educated. And that's very important for your CPA, your attorney as well. And one other point is our goal is trying to stay on a monthly level with you, meaning so that your collateral is always reviewed by your CPA or your counsel. We just enacted this, that on every DST that we want everybody's, any note holder to have not only you looking at your statement, but also having your attorney get a copy of that monthly statement so he or she can see how it's performing. Because what we want is full transparency for each and every note holder to make sure that they're tracking on their investments, but if they go on vacation, their attorney's watching it and making sure that their collateral is safe. And again, it's very important that everybody understands that we're all about protecting them, diversifying them, but yet giving them the extra $1 million that would have went off to the government. But good question, John. Thank you. Any other questions that people might have?
I think we have finished with our time that we allotted. So I want to thank you so much, Bob, and we will make sure we send to everybody that was on the call your information, phone number, email, and all that, so they can call you with any questions, as well as should we also include the tax specialist if they wanted to call him?
Yeah, I mean, that would be great. We could do that as well, or I can set up the meetings, because typically what we like to do is kind of go through the questions that we can ask, get asked and answered, and then if we get stumped, there's a situation, we'll get them on the phone with Todd. We have so many people that call us on a regular basis, but yet we try to protect him from that because he'd never get any work done at his hourly cost. but we'd absolutely love to help everybody here on the phone to get their questions asked by not only their own questions, but even by their CPAs or attorneys or whoever would be representing them. Or we also have counsel in the Bay Area. We have a Lanahan and Riley, which is a very old firm up there that does a lot of DSTs with us. So they're a very good firm, and again, they would be a good choice. Or if obviously we could use your own counselor, whoever you work with and are familiar with. So whatever makes sense. So
I want to thank you so much, Bob. We've got to sign off.
Okay, everybody. Well, thank you very much. I appreciate your time, and we'll look forward to helping you in the near future. Okay?
Okay. Thanks,
John and John. Take care.
Okay. Bye-bye.
Bye-bye now.
Thank you. Please stand by.